Ladies and gentlemen, good day and welcome to the Man Industries India Limited Q1 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mahantesh from Man Industries. Thank you, and over to you, sir.
Good evening, everyone. This is Mahantesh, Manager Investor Relations from Man Industries. I welcome you all to Q1 FY23 earnings conference call of Man Industries India Limited. I have with me from the management Dr. Ramesh Mansukani, Chairman, Mr. Nikhil Mansukani, Managing Director, Mr. Ashok Gupta, Chief Financial Officer, and Mr. Jatin Shah, Company Secretary. We'll have a brief opening remarks from the management followed by Q&A. Please note that this call may contain some forward-looking statements involving risks and uncertainties. Listeners are requested not to put any undue reliance on the facts presented during the call. With this, I hand over the call to Mr. Ramesh Mansukani for his opening remarks. Thank you.
Thank you, Mantesh. Good evening, everyone, and a warm welcome to the Quarter 1 FY23 earnings conference call. Let me begin by giving you a brief of the standalone financial performance for the quarter. We have registered a total income 508 crore, and growth of the top line around 23.8% compared to Quarter 1 FY22. Our EBITDA stood 35 crore approximately, with a net profit 10.5 crore. During the quarter, we witnessed cost of key commodities like metals, polymers, crude, chemicals, etc., and logistic cost also increased because of the war between Ukraine and Russia, which impacted Quarter 1 badly. However, since past July, we are witnessing easing of prices of these commodities and this softening will expect our performance to improve going ahead. With the cooling of steel prices and other raw materials, along the government focus on creating a strong infrastructure for oil and gas and water sector, we expect a higher order over the next few quarters. As on date, our total and unexecuted order, which is approximately 1,000 crore, and will be executed in 5-6 months. Our bid position is approximately 17,000 crore. These bids are at various stages, and we expect to book sizable order over the next few months. Coming to some of the sector highlights, it is expected that the increasing demand for natural gas, petroleum products will drive the oil and gas market over the next 5 years. The Indian oil and gas market is expected to register CRG about 6%, and to cater to this rising demand, oil and gas majors are increasing their capex, develop a network, line pipes, as it is the most economical way to transport natural gas, crude oil, and petroleum products over long distance. We also see demand in the water sector coming on track and increasing in traction across various states. There is a strong intent to achieve the ambitious target set under various schemes like the Har Ghar Jal, National River Linking, etc. The body is well for the piping industry considering the infrastructure requirement to develop this network in the coming years. Update on the capex. I am delighted to share that the work on our ERW steel pipe project implementation is on track and is developing well as per the revised schedule. Along with this, our plans to enter stainless steel business is also been progressing well in order to major order equipment, critical equipment already placed and working going on the full swing. With our enhanced manufacturing and excellent execution capabilities, we are confident to scale our business in the near future, deliver consistent growth. This is all from our side. We can now open the call for question and answer.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Ashar Man, an individual investor. Please go ahead.
Thank you for the opportunity. Sir, I would like to, first of all, I was unable to attend the last conference call. So I would like to point out that Man Industry has violated the SEBI rules, SEBI rules for the listing obligation. I guess the promoter have purchased equity when the trading window was closed during the previous quarter. This is not the first time that it has happened. This has happened in 2019 also. So I would like on the behalf of minority shareholders would bring notice to that if we can focus on the corporate governance side, it would be really good, sir.
Okay, Mr. Asher, I would like to say 2019 there is not any violation regarding to buying the share by any group companies. There may be some other things, not this one. This is the first time in our history, last 25 years, one of the sister concern, they purchased the share and they were not aware the concerning person, the day he put the deal, he was not aware. And once we realized, then it was late. That's why we, under the settlement process, we paid the penalty and we submitted that to the SEBI. I hope that matter is now closed, and it was only 100,000 shares, which was not intentionally, not purposely.
Okay.
Once the company promoters are having share of more than 3 crore 50 lakh shares, so 100,000 not a big thing. This is a purely mistake and accepted by one of the sister concern, not by the promoter company, but one of the promoter company by mistake, they deal in the share. That's why we are.
Yes, sir. Sir, one more thing. I would like to point out about the forensic audit that SEBI had ordered. So, is there any lead from that or report from that?
No, still nothing is happening. We are awaiting some response from there, and as well as the matter is in progress, we will inform you.
Okay, and this cost of the raw materials, which has inflated a lot. So this is for whole of the industry, right? So it is not the Man Industry which is only facing this problem, right?
Yes. About the whole sector, raw material, all of the sector. Yeah. The raw material prices from July onward, last 2 months, is softening. All the sectors, including metals, plastics, chemical, all is coming the pretty high level is slowly reaching. It's a good for industry.
Okay. And I would like to know the volume and value growth on the revenue side.
You are talking about the future or what?
No. Volume growth. We can see that the volume of 400 crores of revenue has risen to 510 crores. So what is the part of the value and what is the part of the volume? Can you bifurcate it if it is possible?
Not possible this moment, but I can give the ballpark figure. The volume is increased, the turnover is increased around 25%, and the volume also almost same.
So we haven't taken any price rise, right? So raw material prices have inflated, but we haven't taken any price rise. So can we
But no,
assume
no
that?
price rise. But in future, whatever the business are coming, price hike is now already passed through stage, and our price formula now we have already taken care about this.
Okay, okay. So quarter two would be the in quarter two we have already taken the price rise. You are telling that, right?
Yes, yes.
And the contract which we had already, the order book, it is not based on escalation clause.
No, normally in our cases, most of the cases, we can say more than 90% cases, our government is buyer. So there is no escalation clause.
Okay, okay. And I would like to suggest only one thing. In case where the raw material beta is very high, can we bring down the time period for the order book? Then it would be really helpful for us to pass on the raw material prices. Then if it is not escalation clause, we can vary our prices at every order.
Yeah, normally we do, once we get the order, we normally do back to back. But the not 100% quantity, maybe 90-95% quantity. Some quantity as per the yield, a lot of other parameters are there which are left out, which is impacted only. That's why the impact was low. But normally we take care back to back basis, and historical maybe 10-15 years once it was once in a while it was a matter.
So sir, last question from my side. Operating margin has fallen to 4.33%. So will this be the operating margin for the next coming 2 quarters, and then it will improve, or what would be your guidance? See, I'm not asking for quarter wise. I'm asking for the whole year or for coming 2 years. What would be your price margin band for the coming year?
We estimate and we are expecting that our EBITDA will go back the same level in future, because we have right now the good order book position as well as to value-added products, and in the coming time good bid book also. So expecting the improvement in all the coming quarters.
So at prudent level, I can assume around 7% of EBITDA, right?
No, not this time 7%, but we will go back the whatever we were doing last year also, which was approximately 10%. We are expecting to go back to debt level also.
Okay, okay, sir. Thank you. That's all from my side. Thank you.
Thank you.
Thank you. To ask a question, please press star and 1. The next question comes from the line of Chirag from Keynote Capital. Please go ahead.
Yeah, thank you for the opportunity. Sir, as you are saying that we have started passing on the cost, or the cost of raw materials are coming down, what kind of gross margin are we looking at from the second quarter itself?
I'm not talking about the gross margin, Chirag. We are talking about the EBITDA. If you see the last year, our 3-4 quarters results, EBITDA 10% plus. And I think except this quarter, we will go back the same level. And normally in our business, gross profit margin, EBITDA, you say, between 8 to 12%. This quarter was very exceptional, and the future quarters depend on should be much better. Value-added coating, which kind of grade the pipe, lot of calculations there. But considering order balance on hand and the bid book position, we are expecting good growth in EBITDA and as well as to order book position.
So what percentage of our order book is value-added products?
Right now, you can say this moment we have around 90% orders roughly are good value-added products. Roughly.
And can I expect that 90% of our books are also based on oil and gas industry?
The 90%, this is a all value-added production. This is from oil and gas only.
Okay.
Only
So
hardly 10% from the water segment.
so it makes sense that we are going to have 10 to 12% operating margin for the next 3 quarters.
Yeah, which we are expecting, as we say, the order book, the original whatever last year EBITDA, we will reach over there very soon.
Okay. So my second question is, so we have the policy of reverse bidding auction, correct?
Yes, sir. In not all cases, in some cases.
Can you elaborate it? What does that mean, that in not all cases but in some cases? Because I was under impression that majority of our orders are based on reverse bidding. So that is the reason we can have a stable gross margin, but that is not the case.
No, I will give a little bit more highlight on this issue. Actually, the Indian PSU, which are now all adopted reverse bidding. But the international market, whatever export bid is there, still is a closed bid, and although it's electronic bid, but not reverse bidding. There is a difference. Indian IOCL, HPCL, BPCL, they follow central government purchasing policy, which is now most of the cases is reverse bidding. For export, no.
Particular. So can you bifurcate the revenue based on domestic and exports for the quarter?
Yeah. This time, this moment, you can say 80% is a domestic, 20% export. But the whatever bid 17,000 crore bid is we put, which is almost 80% export and 20% domestic, just reversal.
Correct me if I am wrong on this, that does export business have comparatively lower margins than domestic business, correct?
Sorry, can you export margin? No, not like that. Export business is a mostly better pricing and less competition, because many locations, very few people are competition over there. Depend on which country, what kind of company is buying the pipe. So lot of parameters are there. So now our export bid book is much higher, and the domestic routine is going on.
Sir, actually, I was under impression that due to higher freight costs, generally export margins are a bit lower than domestic margins in this steel piping business. So you are saying that is not the case, correct?
No, you are talking about export freight. You are talking.
Yes, as we are making more export, we are having an active book of 80% of 17,000 crores into export business. I am expecting our outward freight cost is going to go up, due to which there can be an impact on operating margin. This is my presumption, and I am asking that, is it correct or not?
Right. But nowadays the difference is there. The sea freight, whatever gone up, also it is also cooling down. Now, it is cooling down. So export now are more liquidative. For both are liquidative, depend on country project. Sometime India, sometimes this thing. So we have to see the client requirement and the period of supply. A lot of things are there. But because of the commodity prices cooling down now, the shipping freight also little bit is gone down.
The last question. I was hoping that we had as we are seeing that strong price increase in crude has taken place, due to which even Indian OMC companies are coming up with good capex. Why isn't our active order bid in India so big compared to export? Aren't there any kind of order disbursement from there?
The voice is breaking.
Your voice is not clear. Chirag, once again, can you please come again, please?
Am I audible now?
Yeah, better.
Yes.
Sir, from my understanding, when I heard the calls of OMCs and other peer set of companies into steel pipes, I was expecting that a bit of higher order books and active order books on Man Industries is also related to the domestic players. So I'm not able to understand, like, why aren't we looking at domestic orders currently, and our active order book is also only 20%, which is targeting domestic markets. So I just wanted to understand why is that the case, whereas others are not doing this thing.
At this moment, whatever the order book is there, that is all 90% is on domestic front. But what we are telling that the bid book position where we have bid for almost about 70,000 crores of the project, there around 80% of the bids are for export orders and remaining 20% bids for domestic orders. So we are targeting our turnover maybe equal to balancing 50% for domestic and 50% towards exports.
The end of the year.
Got it. And can I expect that out of this active order book, we can convert 20% into actual orders?
Whatever order books are in hand, that is going to be converted into, that is going to be executed in next 5 to 6 months. And so far as bid book is concerned, it is we have good chances of winning good quantum of order, good portion of it.
No, sir. I'm just asking that historically, I have seen that Man Industry is able to book 15 to 20% of the active order book.
That's what we are having. We are having good chances to win a good amount of orders.
So can I expect that it can be around 20%?
Could be.
Okay. Thank you. Thank you, sir.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. Next question comes from the line of Manish Gupta from Solidarity. Please go ahead.
Thank you for the opportunity. So I had 3 questions. The first one is that, you mentioned you cover back-to-back your steel costs to the extent of 90%. So the question was, why do you cover it to 90? Why wouldn't you just hedge the complete commitment that you have to produce for? Why would you keep 10-15% open?
Manish, good afternoon. Manish, I will reply here. The company policy back-to-back to 90%. The purely reason, the two factors are there. One, yield calculation. Always we do after 75%, 85%. We always review the situation, what yield we are getting. Yield may be 1%, 2% here and there. That's why safe side we book 90%. Okay. Number 2, sir. The other issue, in some purchase order, the client is having the liberty to plus minus few percentage, which is approximately 5%. So we have to consider both the factors. That's why we book 90%, and the 10% we book very close to completion of the project. Here, the quarter which we got the hit, apart from metal, the other items, chemicals, plastic, etc., which is normally we do not hedge. We normally buy on the spot market, normally, because price fluctuations are very less. This quarter was very exceptional problem because of the Russia-Ukraine war in the month of February. Then prices shoot out of the plastic and chemicals in the month of April, May, June. So whatever spot prices, we have to complete the project. Now the situation is reversed last 1.5 months. Then that benefit also we will get in future. So 90% policy is a bad maybe 1 quarter, but good for the future quarters, forever. So this is a company policy.
Okay, very clear, sir. My next question is, sir, can you give us an update on Merino? Specifically, what stage are you in your resolution process? Are you still in discussions? Do you have a verbal agreement? Do we have a term sheet? Is it possible to get some concrete timelines by which this can be resolved?
Yes, sir. I can give this thing that this settlement process is completed. Negotiation is completed. Documentation is going on. And next 2 months, everything will be executed, which I can give this thing.
So that means, sir, you have a term sheet. If you're saying documentation is happening, you have a signed term sheet.
Term sheet, yeah, that's what we are doing.
We have settlement deed. You can say term sheet, settlement deed, whatever you say. And that is executed by them. They send to us. Our law firm has made some changes, which is going on. But almost is finalized, and we hope to sign next week. And then we have the 2 months for execution.
Okay. My third question is, sir, that would you be able to tell us what is the market value of real estate that is on the company's books today? Approximate market value.
Approximate market value approximately is 200 crore.
So in your balance sheet, what is shown at cost, the market value of real estate will be about 200 crores.
We are estimating 200 crore. Actually, our investment is 100 crore.
Okay. And the last question I have, sir, is that, the company is not growing very, very aggressively, 10 to 12% kind of growth. So will you have any surplus free cash flow available to you after you make your CapEx investments?
The CapEx investment is already considered, and our CapEx, more than 50% is already deployed. And this moment, we are not taking any disbursement because the work is smoothly going on. But still, we have some amount to draw in near future as the need of the company.
No, my question, sir, is that over the next 24 months, will the company have any surplus cash after completing its CapEx obligations?
In next 24 months, I can say Mr. Gupta will reply also. He will support me. This current year, whatever ERW will be completed end of the year, so there will be surplus. But after putting up the SS plant next year, whatever will be surplus will be deployed over there. So I'm talking about 24 months.
Okay. So what I hear you say, sir, is that practically speaking, there is no surplus because you need the surplus for the stainless steel plant next year.
Mr. Manish, let me explain in a different manner. See, after having this cash profit in our book for next 2 years, for current year as well as next year, where we are planning to put our ERW as well as stainless steel. So that cash generation plus whatever the asset monetization program, what we are like Marino Shelters, we are planning to dispose it of. Then additional cash we are going to get that additional cash flow from that. And further, though that land deal what we had in our books for 31 crores, that has also been under monetization program.
It is also
and soon it is going to be in the cash form in our books. So we will be having sufficient cash flows even after deploying our cash for CapEx program.
So my question, sir, very simply, is that you have 200 crore of real estate on your books. You have surplus cash. The promoter holding is well below 75%. Why would you not more aggressively buy back your stock?
Let the time come. We will once this whatever asset monetization program is going on. If any find we will see if we have the sufficient surplus funds in our books physically, then probably we can think of for buyback on other options.
Manish, in simple words, Mr. Gupta is saying we have monetizing the Marino, we are monetizing the Bellary plant which we already sold. Money will come next month. This is the problem which between the Piramal, etc. will be finished by this thing. Then we will be more confident to say what will be the excess money in future. The first excess money to clear everything put in our expansion program, and what will be the surplus, and then we will see what can be done. But this moment, difficult to comment on this issue very firm date.
As on
Very
our
clear.
first target is to complete our CapEx program.
But your suggestions are well taken. But at this moment we are non-committal. We want to finish all old matters first top priority. Next two.
Okay. Okay, sir. Very clear. Thank you.
Thank you, Manish.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. Once again, a reminder to all the participants that you may press star and 1 to ask a question. Next question comes from the line of Manjit Paria from Solidarity Investment Manager. Please go ahead.
Hi, good afternoon, sir, and thanks for taking my question. I just wanted to understand what is the outstanding loan in Merino and at what percent is the settlement being roughly done. So, I just want to understand what is the excess we will have as equity after the settlement is done.
Sir, we have signed the NDA with the borrower and lender, and documents are under execution. And this moment to comment, this is not a right time because we are abide by the legal procedure. So please wait for a few more weeks. You will get to know what we have done. But it's a larger interest of the shareholder. That will be the good thing is being done.
Okay, sir. We'll wait for that update. The second question was the 200 crores market value of real estate approximately which you mentioned. This is housed under the Merino subsidiary. Am I correct? Or is it on standalone balance sheet of the company?
Can you just repeat your question?
You mentioned the market value of the real estate which the company has is roughly 200 crores. Is this under the Merino legal entity or is this under the standalone? Is this on the standalone balance sheet?
No, sir. This is a value of the project. Only one project in that company, and we are disposing of. Then some liabilities also will go. Company will get the money, and then the situation will be more clear. Only one project that company, nothing else.
Okay, but I'm just clarifying this project is in Merino. This rupees 200 crores approximately is a project that is in Merino.
The 200 crores is basically for all the asset which Man Industry owns, which has Merino and one more land in Karnataka, which put together make it a 200 crore asset.
Got it. And would it be possible to split it between?
Out of which 40 crores is directly on the Man Industries and Merino Shelters is around 160 to 150 crores.
Very helpful. Thank you for clarifying this.
Yeah.
Thank you. Next question comes from the line of Arvind, an individual investor. Please go ahead.
Hello.
Yes, sir.
Hello. Thank you for giving me the opportunity. I have three questions, sir. First one is, as you said, out of 17,000 bid book we have, so how much percentage will be successful in getting the orders? How much percentage of that 17,000 crores?
Sir, 17,000 bid. This is all the time very dynamic. Every time it changes. What will be the percentage of success? What is the evaluation stage? There is a very different conditions. But we can say whatever our requirement of the business to fulfill our order book, will be sufficient so far.
My second question is, sir, can we have some revenue guidance for coming next 2 years?
Revenue guidance, as we discussed last time also, we are anticipating some growth, good growth in this year. Depend on some projects we already bid it. The situation will be more clear in next 1 month. And next year will be the additional revenue, apart from the growth, will be additional revenue from ERW and some value-added products also. In percentage-wise, I cannot say right now what will be, but there will be the good growth in 23 as well 23-24 also.
Okay. And my last question is regarding the non-interest shares, bonus shares. Is there any clarity on that?
What sir, your question?
Regarding non-infra bonus shares.
No, you are talking about the bonus share?
Yes.
No, right now we cannot comment on this issue, please.
Because this
all the commitment for the bonus share regarding for Man Industries we've already done, and then now the matter is prejudiced in court from the other side. So from our end, from Man Industries end, everything is complete.
That is from last 2 years the same issue is pending.
We are trying as soon as possible court decision, then we will see.
Can we have some specific guidelines for timeline?
No, sir. Matter is sub judice. Our legal team is trying to, as soon as possible, to resolve, to give good news to you.
Okay. Thank you, sir.
Thank you. As there are no further questions, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Nikhil? Thank you everyone for your participation in Q1 Q2 FY23 earnings call. In case of any further queries, feel free to get in touch with us. Thanks a lot for your time and attending this process. Thank you, sir.
Thank you. On behalf of Man Industries Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.